The US CPI has fallen to 5% year on year for the month of March. That's its lowest rate for 2 years since peaking last June. That's the ninth straight month the country's CPI figures have dropped. Experts say the US Fed Reserve still likely to increase the cash rate by 25 basis points when it meets in May, despite the news. The Federal Reserve is taking an aggressive approach to interest rates in a bid to drop inflation to its desired 2% level, which is what it is here as well. Joining us live now, Chief Market Strategist at InvestSmart, Evan Lucas. Evan, so US inflation continues to fall, but rate hikes, as we just mentioned there, still on the cards.
Yeah, and I think what you've got to highlight there, Pete, is the CPI data for the core level. So we actually saw core CPI year on year go from 5.5% in February to 5.6%. It was in line with expectations, so analysts had expected that to be the case, but that is what everybody's picking up on in terms of why rates are more likely to rise than not. You've seen most analysts sort of revise that if the pause is going to come in the US, it's going to come in June at the earliest, more likely actually at their August meeting. The big part that also caught most people's attention, and this is a big thing that we here in Australia have to watch, is rental increases. The inflation in rents in the US hit a record 8.3% increase in terms of that space. And that is something that we here are going to probably start to see very, very soon. Between May and September is the most continuous sort of renewals of rents in this country. And we obviously have to deal with 10 rate rises that have basically started since May last year. So that is why watch that space in those subsectors. Rent is going to be probably the biggest headwind and the biggest issue that we face, along with the US, in that core inflation reading about why inflation may become quite stubbornly high as price gets passed through.
Okay, Evan, local jobs data is due today. Why is migration now becoming an issue for the labour market?
So we keep hearing about migration and the fact that we're having this incredible surge of people back into the country in the post-COVID world, which is a very good thing. We're also seeing that that issue is now flaring up, as I just discussed before, about rents. Now also coming up in what's going on in employment. Expectation is that for the unemployment rate to tick up ever so slightly to about 3.6 from 3.5%, migration now is actually starting to see that the competition for every job advertised is starting to grow. Now, that is seen as probably a good thing. There's a double-edged sword to that, though. It means, therefore, that the wage increases that have been starting to come can start to flatline because there are more people competing for certain jobs. It also means that participation now is starting to get to a level that we haven't seen, so it's growing quite rapidly, which is a good thing to see. But it may also therefore mean that once those migrants are counted, that the unemployment rate actually starts to rapidly increase because they don't have jobs. They're here looking for work, but they don't have it. So watch that space. It's not just the housing issue. Migration now is starting to put a pressure on unemployment.
So it will inevitably lead to the question. I mean, we talked about this a couple of weeks ago, 650,000 migrants this year and next financial year. I mean, inevitably people will say, well, is that too many?
Yeah, so the other thing that's happening, obviously, with rate rises and a slowing economy is that businesses just aren't hiring, right? So they're starting to put the freeze on hiring. And you're right to argue that if you're having that many people come into the country, if you're having a slowing economy and therefore a slowing jobs market, where do they go? What do they do? So that is why that question has been raised. I mean, are they coming too quickly? It's great to have them back. We need to put that very clearly that they are a very, very good part of our gross domestic product. They're clearly helping keeping that side going. But they will leave if they can't get employment. They will leave if they can't get housing. And that's the catch-22 here is that it's nice to have them back. We really do need them. But if they're coming at a rate that we can't sustain them, then that will be a problem.
Now, this is we just had this in our news. Stunning admission, really, from the RBA board member Ian Harper yesterday, Evan, who's admitted the bank has done a, quote, terrible job after the pandemic. Most people agree with him, but it's interesting that we've had that confirmation from the RBA.
Yes, and look, it is a quote that has come from a panel discussion. So he is the only one I've actually seen use that term. So just put that out there. Again, if you have a look at the deputy head, Michelle Bullock, she was online yesterday giving a major speech. She somewhat disagreed with that comment in that what she points out is that, yes, there was certainly comments and lines, and I know that you're very strong on the line around the 2024 rate rise discussion, that they have done badly and that hindsight's a beautiful thing. There is no doubt that the RBA was overly cautious, was extremely accommodative dealing with the pandemic and probably forgot about one mandate being inflation, and they're now having to scramble to fix that. And that, I think, is core front and centre, not just for the RBA, but globally, is that the extreme caution, the extreme accommodative stance that the world took to deal with the pandemic has now basically kicked the can down the road of what that year brought for the rest of the world, which was that an economic issue has basically now flared the end of last year and now into this year that probably would have happened in 2020. So instead of having to deal with all that at once, we have dealt with a health crisis. Now, unfortunately, we're dealing with the economic one.
Okay, quick one here, Evan. How are the markets today?
We are probably going to be a little bit negative. I mean, it's going to be flat, but we've had two incredible days. We've had a 1.3 and also a 0.7% increases. So it would probably be healthy to see us do not much today.
Okay, Evan Lucas, chat to you next week.